Trump's tax legislation, temporarily easing one crisis, exacerbating future financial challenges. Summary. Rising Treasury yields amid fiscal concerns. Tax reforms estimated to slash tax revenue by $4.5 trillion over 10 years, expected to enhance corporate profits and boost stock market values. New York, July 3rd, Reuters. The recently approved tax cut and spending legislation under President Donald Trump has temporarily sidestepped the threat of a U.S. government default, but it simultaneously aggravates the nation's long-term financial troubles. The tax bill, passed by Republican lawmakers in the House of Representatives, extends Trump's 2017 tax cuts, allocates additional funding for border security and the military, makes significant cuts to Medicare and Medicaid, and adds trillions to the national debt. Trump is anticipated to officially sign the bill into law. To avoid a looming debt crisis, lawmakers also increased the U.S. government's $36.1 trillion borrowing limit by an additional $5 trillion, thereby temporarily easing the risk of failing to meet payment obligations on U.S. debt. However, looking at the bigger picture, the tax bill spells trouble for the U.S. bond market and the country's overall fiscal stability. It could add an estimated $3.4 trillion to the national debt over the next decade, intensifying concerns about an increasing supply of government bonds and a shrinking demand for U.S. treasuries, which have significantly influenced financial markets recently. But here's where it gets controversial. This expansion of debt is a critical concern highlighted by BlackRock, warning that foreign investors are increasingly skeptical about holding American debt. What happens if demand for the $500 billion in weekly U.S. debt issues decreases? This could drive borrowing costs higher. And this is the part most people miss. While the tax bill aims to stimulate growth by offering tax breaks and full expensing for equipment purchases and R&D costs, some worry that this surge of debt might limit the intended economic benefits. Camp Goodman, a bond-focused portfolio manager, believes that the legislation could lead to a modest 0.5% boost in economic growth next year. However, market complacency regarding the potential for higher borrowing costs could create long-term challenges. We anticipate that the one big beautiful bill will foster significant corporate earnings growth, driving stock market values, noted Ellen Hazen, a chief market strategist. However, the potential for long-lasting elevated treasury rates could make many fixed-income investments less attractive over time. Recent increases in 10-year treasury yields partly reflect investor jitters over fiscal issues. Andrew Brenner of National Alliance Capital Markets comments that this could be a sign that bond vigilantes, investors who toughen their stance on governments with unsustainable debt, are vigilant about U.S. fiscal policies. Debt limit relief. The increase in federal borrowing limits provided by the new bill removes the risk, though minimal, yet potentially catastrophic, of a U.S. debt default, which could disrupt global markets. In recent weeks, short-term Treasury yields rose as concerns about the approaching debt ceiling, or X-date, increased. I believe that the newly approved bill alleviates some debt ceiling fears, potentially lowering yields on August maturing Treasury bills, explained Vinnie Blue, director at Raymond James in Memphis. The bond market response to the bill has been relatively muted, as investors had already accounted for a rise in deficits following Trump's January re-election. The focus has now shifted to worries about economic growth. What do you think about this balancing act? Is the immediate relief from a debt ceiling crisis worth the long-term increasing national debt? Share your thoughts in the comments below.